Welcome to The Explainer, everyone. Today, we're diving into the fascinating and honestly foundational world of fixed income. If you've ever looked at your investments and felt like your portfolio was just a bit too much of a roller coaster, well, you're exactly in the right place. We're going to break down the mechanics and the subtle nuances of the bond market, giving you the tools to balance your portfolio like an absolute pro. Here's our game plan for today. We'll hit bond basics, check out the price and yield seesaw, look at the big three bond types, shine a spotlight on municipals, and finally, wrap things up with fixed income risks. Let's get right into it. Section 1. Bond Basics. Let's look at the actual mechanics and features at play here. Okay, so the absolute most crucial thing to grasp right off the bat is that when you buy a bond, you aren't buying a piece of a company like you do with a stock. Actually, scratch that. It's completely different. You are acting as the lender. You are literally lending your hard-earned capital to a government, a municipality, or a corporation. And in return for your cash, that entity is legally obligated to give you two things: a steady stream of defined interest payments over a set time, and a massive balloon payment at the very end to return your initial principal. Just think about the timeline of how this works. Your initial $1,000 goes straight to the issuer. Then, through year 1, year 2, year 3, and so on, you collect those semi-annual interest payments, what we in the biz call coupons. Finally, at the end of the line, when the bond hits its maturity date, the borrower pays that original $1,000 right back to you. It's a highly structured, perfectly contractual cash flow. So why do we actually want these in our portfolios? Well, think of it this way. If stocks are the high-revving growth engine of your portfolio, bonds are the structural walls. They give you super reliable income generation through those coupon payments. They offer capital preservation because high-quality issuers have a massive proven track record of returning your principal right on schedule. And honestly, perhaps most importantly, they offer diversification. Historically, high-quality bonds just don't move in tandem with equities. They tend to zig when the stock market zags, which keeps your overall wealth much steadier when the market decides to panic. Moving right along to Section 2, the price and yield seesaw. Let's explore this crucial inverse relationship. All right, pay close attention because this right here is literally the golden rule of fixed income. Once a bond is trading out in the wild in the secondary market, its price and its yield are inextricably linked in a completely inverse relationship. When market yields fall, the price of existing bonds rises. And when market yields rise, you guessed it, the price of existing bonds falls. If you can just lock this seesaw concept into your brain, you will always, and I mean always, understand bond market movements. Think about it for a second. If you own a bond paying 3% interest and suddenly prevailing market rates shoot up so that brand new bonds are paying 5%, nobody's going to want your 3% bond anymore, right? Not unless you lower its price. So, as the yield goes up on one side, the price absolutely must come down on the other side to balance the whole thing out. All right, Section 3, the big three bonds. We're talking treasuries, munis, and corporates. Taking a bird's eye view here, you can really see the distinct trade-offs you have to make as a lender. On one end, we have U.S. treasuries, issued by the federal government, carrying virtually zero credit risk, but generally offering the lowest yields. On the flip side, we have corporate bonds. These are issued by companies, so they carry higher credit risk, but they offer the highest yields to compensate you for taking on that risk. And sitting right there in the sweet spot in the middle, municipal bonds, issued by state and local governments, offering moderate yields, but with some pretty fantastic, unique tax advantages. You see, each of these bond types kind of has its own distinct personality. Treasuries are your ultimate safe haven. Highly liquid, sure, but fully taxable at the federal level. Corporates, those are your income engines, but they're fully taxable at all levels, and you really have to keep a close eye on the financial health of the underlying company. And municipals, well, they're the tax-advantaged workhorses. Picking the right one for you depends entirely on your personal risk tolerance, how much liquidity you need, and of course, your specific tax bracket. Which brings us to Section 4, Spotlight on Municipals. Let's dig a bit deeper into these tax-advantaged workhorses. $4.2 trillion. Yeah, trillion with a T. That massive number is the size of the outstanding municipal debt market. It is just an enormous ecosystem. And what's totally wild is that this debt is issued by an astonishing 70,000 different state and local government entities all across the U.S. We're talking everything from states and massive cities, all the way down to your local school districts and water authorities, all raising capital to fund projects for the public good. So When you actually go out and buy a muni, you're generally picking between two primary flavors. About 30% of the market consists of general obligation, or GO bonds. Now, these are incredibly secure because they're backed by the full taxing authority of the government. The other 70%, those are revenue bonds. These are issued to finance specific projects. Think a new toll road or hospital expansion, and your repayment is tied directly to the revenue generated by that exact project. It is super vital to know if your interest payments are relying on broad taxpayer money or just the success of a single local utility. Now, the absolute superpower of the muni bond is its tax status. They are generally completely exempt from federal taxes and often state taxes too if you live in the issuing state. Because of this, you've got to use a specific calculation to fairly compare them to fully taxable corporate bonds. You take the muni yield and divide it by 1 minus your total tax rate. When you do this math, you might be shocked to discover that a tax-free muni yielding just 2.5% actually puts more after-tax money in your pocket than a taxable corporate bond yielding 5%, especially if you're sitting in one of those top tax brackets. It's kind of like a financial optical illusion. But look, the muni market definitely has its quirks. Because there are 70,000 issuers and over 1 million active unique bond issues, which is way more than any other fixed income sector, this market can be highly inefficient. Financial reporting from small local towns can be pretty inconsistent. Plus, transaction costs, specifically bid/ask spreads, vary wildly depending on your trade size. Selling a tiny $25,000 position, you might get a much worse price than if you were offloading a massive $1 million block. These inefficiencies can definitely create traps for the unwary retail investor who panic sells, but they also create fantastic pricing opportunities for the savvy investor who knows exactly where to look. And finally, Section 5, Fixed Income Risks. It's time to step back and look at the macroeconomic weather. Remember that seesaw we talked about earlier? Well, the longer your seesaw is, the wilder the ride. When you compare long-term 10-year treasuries against short-term 3-month treasuries over time, you'll see the 10-year moves with far more dramatic, sweeping volatility. This perfectly illustrates what we call duration risk, the reality that the longer you lend your money out, the more sensitive your bond's price becomes to changes in interest rates. A 10-year bond is going to swing much, much harder in price than a 3-month bond every time the Federal Reserve decides to make a move. But hey, it's not just interest rates rocking the seesaw. You have to stay vigilant about a few other hazards too. First, there's credit risk, the real danger that a corporation or municipality just outright defaults and fails to pay you back. Then there's call risk, where an issuer decides to pay off the bond early because interest rates dropped, which unfortunately forces you to reinvest your cash at those new, lower rates. And lastly, the silent thief, inflation risk. Because your bond's coupon is fixed, soaring inflation can quietly eat away at the real future purchasing power of those steady payments. Understanding all these building blocks, the math behind the seesaw, and the unique personalities of treasuries, corporates, and municipals, that absolutely empowers you to make drastically smarter financial choices. So I want to leave you with this final thought as you evaluate your own investments. When the macro weather turns, is your portfolio's foundation built on solid stone, or are you just standing on an unbalanced seesaw? Thanks so much for joining me for this explainer, and hey, happy investing.